What's up, guys? I'm Nobody Special, and today China's central bank, the PBOC, lowered interest rates very unexpectedly. This comes amid news last week where Country Garden, the largest developer in China, had to abandon plans for a $300 million bond sale because nobody wants to lend them any money. And we've been saying on this channel for a couple of months now, watch out for Country Garden and watch out for those Chinese banks. The situation with the Chinese real estate collapse is spreading. It's spreading faster, and this action today taken by Chinese central bankers tells me that the situation is a lot worse than they're willing to admit. You ready? Hit it. Thank you for joining me. I'm Jack Campbell, and I'm Nobody Special. And if you've been following this channel for a while now, you've heard all about me talking about the Evergrande crisis and how Evergrande is really just the symptom, not the disease, that the disease is the collapse, the outright collapse of the Chinese housing market. Well, there's been two big developments recently. First of all, Country Garden, the largest developer in China, even bigger than Evergrande, their bonds have been selling off big time because they had to abandon plans to raise $300 million through a convertible bond offering. That tells me that there is no appetite for Country Garden debt, even though Country Garden is supposedly a relatively healthy company. Maybe things at Country Garden aren't as rosy as they say they are. And the other thing that happened was just this morning, Chinese central bank, the PBOC, or the People's Bank of China, lowered key interest rates by 10 basis points. This came out of nowhere, as most analysts had expected the PBOC to leave rates right where they were. Now, we've been saying on this channel for a while, watch out for Country Garden because they're a huge outfit and they're supposedly healthy, and watch out for China's interbank lending. That's when this goes from a real estate crisis to a wholesale financial crisis. And between this video I made about Minsheng Bank earlier this week, and now today the PBOC lowering interest rates, these stories tell me that the situation in the Chinese housing collapse has already spread to the financials. Now, before we get into the numbers, folks, I have to ask, could you please like this video and subscribe to my channel? Don't forget that notification bell. It really helps me out. It helps me to keep this channel growing, and I'd be forever in your debt. And also, folks, share this story. Send this video to your friends. Tell people about this because this is such a huge story. And even though it's starting to get at least limited coverage in financial press, most people have no idea what's going on in China and just how bad things could get and how this could spread across the pond to the US and European banks. And this could cause problems for just about everybody. And now with that, it is time to shrink my big fat melon of a head. And let's get into this article. This is in CNBC. This is dated last night. China cuts rates on policy loans for the first time since April 2020. All right, so not since the onset of the unfortunate health situation, which shall remain nameless, has China's central bank lowered rates. Just want to get into this a little bit here. China's central bank on Monday cut the borrowing cost of its medium-term loans for the first time since April of 2020, defying market expectations to cushion any economic slowdown. The People's Bank of China, or PBOC, said it was lowering the interest rate on 700 billion yuan, or $110 billion, worth of one-year medium-term lending facility loans to some financial institutions by 10 basis points to 2.85% from 2.95% in previous operations. 34 out of 48 traders and analysts, or 70% of all participants polled by Reuters, last week predicted no change to the MLF rates, although a rising number of market participants start to forecast a rate cut. With 500 billion yuan worth of MLF loans maturing on Monday, the operation resulted in a net 200 billion yuan of fresh fund injections into the banking system. So, this is all a lot of fancy bank speak for China's central bank is pumping money into the banking system. They are trying to make money easier to lend, easier to borrow. If everything was fine in the Chinese banks, they wouldn't have to do this. All right? So the debt markets are getting tighter. It's getting harder to borrow, and China's central bank is worried that this wave of defaults is going to snowball out of control, and so they're trying to make it easier to refinance debt. Now, keep in mind, this flies in the face of Xi Jinping's 3 red lines policy, which is all about discouraging debt and trying to get these real estate developers to slow down the rate at which they're borrowing. So this is something of Chinese central bankers walking back this gung-ho approach to attacking a debt crisis. And I've been saying on this channel for months now, the fact that China's government rules with such an iron fist is not an asset in this scenario. It's not that they have an unlimited ability to deal with this crisis. It's that their ability to mess things up further is unlimited. And now this is what we're seeing, this 3 red lines policy and this too little, too late crackdown on debt has actually accelerated this wave of defaults, and now the bank is having to backtrack somewhat. The central bank also lowered borrowing costs for 7-day reverse repurchase agreements or repos by the same margin to 2.1% from 2.2% when it offered another 100 billion yuan worth of reverse repos into the banking system on the day, compared with 10 billion worth of such short-term liquidity tool due on Monday. Again, this is financial long speak for pumping money into the system. So why are they doing this? Why is China's central bank suddenly worried and suddenly pumping money into the system? Well, if you ask me, it probably has a lot to do with two stories that came out this week. And the first story is that of Country Garden. Now, I've been saying on this channel for a while, Country Garden is the mother lode. This is the biggest developer in China. They have over 3,000 commercial real estate projects around Asia. Okay, these guys are even bigger than Evergrande. Now, Evergrande has been getting all the headlines because Evergrande has the biggest pile of debt. But in terms of sales, in terms of project numbers, Country Garden is far bigger than Evergrande. So this shows that even the healthy players are not immune to what's going on in Evergrande. And this is in the Wall Street Journal, and this is dated today. Chinese property giant Country Garden endorsed sector's latest sell-off. Company stock fell 8.1% on Monday in Hong Kong to reach its lowest closing level in 5 years. Investors in Chinese property bonds can't catch a break as a crisis of confidence spreads to stronger-looking developers that mostly avoided last year's sell-off. Remember this video I did about Shimeo a couple weeks ago, where Shimeo was an otherwise healthy company that had not violated any of the 3 red lines policies. And all of a sudden, Shimeo's bonds and Shimeo's shares started selling off for no reason. Next thing you know, Shimeo is on the brink of bankruptcy. So this goes to show you that even these seemingly healthy developers, number one, we don't know how much secret off-balance sheet debt they have, how many of these wealth management products they forced on employees and unsuspecting investors, or how many trusts and loans they have set up through these secret subsidiaries that are not on their balance sheet. Just the books are a mess at these companies. We don't know how much of that is going on, and because of that, the debt markets are squeezing the cheeks, and they are not lending to these companies, and that is taking healthy companies and making them unhealthy, like we see with Country Garden here. The most recent cause for concern, Country Garden Holdings, which was China's largest developer by contracted sales last year, according to China's Real Estate Information Corp. It's one of the few privately owned companies in the sector with much healthier credit ratings than its highly leveraged peers. Country Garden has an investment-grade credit rating by 2 of the 3 main ratings agencies. And that's another theme we've seen playing out. The ratings agencies are not on top of their game in China. For whatever reason, these ratings agencies, which investors rely on for accurate information to gauge risk, these ratings agencies are not accurately handicapping these companies. They're behind the curve. By the time the rating agencies download these companies, it's too late. You've already lost your money. And here we have Country Garden's bonds selling at 67.5 cents on the dollar in some cases, and yet 2 of the 3 ratings agencies call them investment grade. You're lucky to get 2/3 of your money back, but somehow they're investment grade. Okay, the ratings agencies are asleep at the wheel, and that is a common theme we saw in the global financial crisis back in 2007, 2008. The ratings agencies were rubber stamping all those mortgage-backed securities AAA rated when really it was garbage. Reading on in this article, until recently, Country Garden's dollar bonds had been largely insulated from the broader sell-off triggered by government curbs on borrowing, aka the 3 red lines policies, declining home sales, and financial difficulties at rival China Evergrande Group. On Monday, however, a Country Garden bond due in 2026 was quoted at just 67.5 cents on the dollar, according to TradeWeb. The bond, which is rated investment grade by 2 of the 3 major global credit rating firms, has declined steeply in recent days, dropping by more than 20 cents on the dollar in 3 sessions. And folks, bonds are not supposed to trade like that. All right? Bonds are considered safe investments. They're supposed to be boring. They're supposed to trade sideways. You're not supposed to drop 20 cents on the dollar in 3 sessions. It's not how this works. Meanwhile, the company's stock fell 8.1% Monday in Hong Kong to reach its lowest closing level in 5 years, while shares in some smaller competitors such as Seafy Holdings and Sunac China Holdings also fell. Analyst investors said Country Garden's recent change of heart over a potential fundraising had helped unnerve investors. And this is where the story comes from. And this, I think, is what is really causing the sudden action by the PBOC. Last week, the developer decided not to proceed with selling a convertible bond. This was worth about $300 million after bankers at Morgan Stanley and JP Morgan Chase failed to garner sufficient interest from investors for a potential $300 million bond deal, a person familiar with the matter said. So the company went to the debt market to borrow $300 million, most likely to refinance older debt, and they couldn't find enough investors. They couldn't find any appetite for that $300 million in debt, so they abandoned the plan. And when they abandoned that plan to raise $300 million, the bond market said, oh my God, Country Garden just tried to take out a loan and they couldn't get it. Something's wrong with Country Garden. And everybody started rushing for the exits, selling Country Garden's debt. And if you ask me, this is what spooked the People's Bank of China. This is why the central bank is loosening lending requirements. They saw the biggest developer in the country, which had previously been considered safe, unable to borrow money, and all of a sudden their investors are panicking. The PBOC needs to restore confidence. They need to loosen up lending in the markets. Right now, nobody wants to lend money to a Chinese developer. And can you blame them? This is where money goes to die. And here you can see in this chart right here, this is Country Garden's dollar bond due 2026. And look at the plummet starting up on July 14th when this crisis was really just starting, trading at 110 cents on the dollar, and then just bang, 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 slowly whittled down to now 79 cents on the dollar as of right now. And this really cracked me up when I saw this. You want to talk about telegraphed weakness. See if you notice anything in this emailed response from Country Garden. Reading from this article, in an emailed response to questions, Country Garden said it held more than 186 billion yuan, or the equivalent of $29.3 billion in cash, as of June, and had strong cash flow. The company said it recently issued onshore corporate bonds and asset-backed securities, reflecting its standing with investors and regulators. Okay, so there's a lot going on in this statement that I had a problem with. First of all, let's look at the cash numbers. Okay, they say they had $29.3 billion in cash. Well, that is very reassuring because they only have a few $100 million worth of debt that's coming due in the next week or so, and then a few $100 million more coming due in July. However, did you notice that little rider they had attached to that $29.3 billion? That was the cash that they had as of June? Well, folks, June was 7 months ago. Right? If you're trying to borrow money from somebody and somebody says, can you pay me back? And you say, well, yeah, 7 months ago, I had lots of money. Is that going to make you feel any better? So they're trying to make themselves sound more secure by talking about how much money they used to have. Folks, these developers have been burning through cash like crazy. Their sales are absolutely in the toilet. So who knows how much of that $29.3 billion is even left right now? Again, not a very reassuring statement. I think this was meant to be reassuring. I can't imagine anybody is reassured by it. And the other thing I want to point you to is the second half of this statement. The company said it recently issued onshore corporate bonds and asset-backed securities reflecting its standing with investors and regulators. So they're trying to say, even though nobody wants to lend us money now, a few weeks ago, they were willing to lend us money because we sold these mortgage-backed securities and these corporate bonds. Well, no, if you had a good standing with investors and regulators, you wouldn't have had any trouble selling that $300 million in debt this week. Don't tell us what happened last week. What have you done for me lately? And also, watch out for this, folks. Oh boy, did you notice that? Asset-backed securities. The company said it had recently issued onshore corporate bonds and asset-backed securities. That is commercial mortgage-backed securities, or CMBSs. Oh boy, watch out for that. It's those asset-backed securities, those CMBSs. That's when this goes from a crisis of confidence in real estate developers to a whole-scale banking crisis. Keep an eye on that phrase right there. And I want to mention this paragraph down here also. Investors have cooled on some other comparatively strong developers in recent weeks, including Shimeo Group, which had fallen behind on some payments due on trust loans. These are a form of shadow financing in China that is popular with the country's property companies. And again, Shimeo had been one of those healthy developers that did not violate any of the 3 red lines policies. They had investment-grade credit ratings from all the companies, and right now that company's on life support because it turned out they had hundreds of millions of dollars in secret debt that the market caught wind of, and then the bonds and the shares in the company started selling off. So if something like that could be going on at Country Garden or some of these Chinese banks, like, say, Minsheng Bank. Remember I did that video a few days ago about Minsheng Bank? Folks, the situation, it is spreading. This is what they mean by contagion risk. When you have seemingly healthy companies that can't access debt markets because of what's going on at Evergrande and these other developers, that's how you get a debt crisis at otherwise healthy companies. And it starts to expose weaknesses that were beneath the surface at those other companies that you didn't know about. Shimeo is a perfect example of that, and now Country Garden. And here, this is in a Reuters article. I just wanted to show you this chart. This shows a couple of Country Garden's bonds, and this is going back to the beginning of December, and you can see they were pretty much trading at par or about 95 cents on the dollar for most of December. And then early this year, bam, they started selling off. And then right about here, this is where that failure for the $300 million convertible bond offering was, and the bonds have just sold way down ever since then, now trading at 67 cents on the dollar, 74 cents on the dollar, and about 77 cents on the dollar. Again, these all have investment grade ratings from 2 of the 3 ratings agencies. What is going on at the ratings agencies? And since we just love charts on this channel, I also want to show you this chart here. Now, this is showing, going back all the way to 2017, this is China's GDP, China's industrial output, and China's retail sales. Now, keep in mind, China's GDP numbers are absolute horse manure because according to China, their economy grew by 4.4% in the fourth quarter. And I can tell you there's absolutely 0% chance that China's GDP actually grew in the last quarter. Not when they're shutting down all their steel mills, not when their coal mines are flooding, not when their property development industry, which is a third of their GDP, is absolutely frozen in place. There's just no way China's economy grew in the fourth quarter. So first of all, you have to consider even these numbers are total horse manure. They are way too high. But look at this chart. Look since Q1 of 2020, what's happened in GDP, in industrial output, and in retail sales. And remember that retail sales number, folks, because right now the Chinese consumer is a big target of American multinational companies. And we've done a video before about the wealth effect and how when people's homes go up in value, they feel more wealthy and they spend more money. But the reverse is also true. When people's homes go down in value, they spend less. And right now, homes are dropping in value in China like never before. So the Chinese consumer is going to slow down his spending big time. That's going to hit U.S. stocks. It's going to hit U.S. multinationals. Think Apple, think Caterpillar, think pretty much everyone in the S&P 500. And again, these Chinese GDP numbers, they are doo-doo. And lastly, I want to mention, we've been talking about watch out for those Chinese banks, that's when this goes from a real estate and a developer crisis to a full-fledged financial crisis. And I want to remind you about this story that came out earlier in the week. The world's worst performing bank lending billions of dollars to China Evergrande, and that is Minsheng Bank, and that they have about $20 billion of exposure to Evergrande and other developers, representing, according to the article, about a fifth of their Tier 1 capital. We mentioned in a video we did on this one that you just can't trust the numbers coming out of these banks, so who knows how much Tier 1 capital they really have and how bad the situation really is. So long story short, there was a couple of stories that really sent shockwaves through China's economy this week. Mainly, it was that Country Garden story. When Country Garden couldn't find a market for that $300 billion in new bonds, investors panicked and started dumping Country Garden's debt. And Country Garden is the whale in the room, all right? That is the biggest developer in China, one of the biggest in the world, even bigger than Evergrande. And the other was that early sign of warning at Minsheng Bank that they have a lot of exposure to Evergrande and other developers' debt. And again, they have that sleeping giant in the room. We don't know about those off-balance sheet debts, those wealth management products, or those trust loans. So there's no telling just how big this debt crisis really is. And that caused this unexpected action from the PBOC today, where they injected capital into the markets to try to loosen lending, to try to save some of these companies and to try to slow down this wave of defaults. It's not going to work. It's not going to be enough. So we're going to keep an eye on this story. We're going to keep an eye on these seemingly healthy developers that are now showing signs of weakness. We're going to watch for more downgrades. We're going to watch for more signs of trouble in the Chinese banking system, more assurances from Chinese central bankers and regulators that everything is okay on one hand, while on the other hand, they take actions to loosen monetary policy. Again, this story is far from over. And folks, please help us get the word out about this story. This is a very big deal, and it's still not getting nearly enough attention in the press. This could very easily spread to European and U.S. banks. You got to wonder, how much do our pensions, how much do our 401ks of this garbage Chinese debt could these institutions be secretly holding? Chances are you're invested in this crap and you don't even realize it. Guys, I want to thank you for your time. Thank you for watching this video. Don't forget to hit that like button, subscribe to my channel, and hit that notification bell. It really helps me out, and I'd be forever in your debt. Until next time, live small and dream big.